So let me go ahead and pull it up and get started. All right. And can somebody hop off mute and tell me if they're able to see this?
Yep, you're good.
All right, thank you, Olivia. All right, so good afternoon, everyone. I'm Cobalt. I'm a senior financial economics major. I'm president of the investment group here on campus. We say group, but really it's a club like every other group. Sounds more professional, so that's why we use the term. So I'm just going to be talking a little about sort of the basic introduction to investing and what's out there, and sort of some of the risks and disclosures you should be looking out for, because in due time we are going to get adult jobs and start making some serious money. So definitely something we want to be doing with that money is investing it. So let's go ahead and jump in. So the agenda, we're going to be talking about what is investing in general, some of the terminology, the investment accounts that exist, some common misconceptions that a lot of people associate with investing, sort of like rookie mistakes. Then we're going to hop into what is a broker dealer and risks associated with investing in broker dealers in general. And then we're going to hop into some of the tax implications. Unfortunately, there are taxes with investing. So if you make a lot of money off of your GameStop shares, you don't get to keep all of it, unfortunately. So what is investing? So investing essentially is it's putting money into a thing and making more money off of that thing. Is probably the most basic and layman's term definition there is. So I know everybody, or the majority of everybody in this group, probably has a savings account with their bank. How a savings account works is that you put money into it and you sign an agreement that allows the bank that oversees the account, they then use that money to lend it out to other people, and then they charge an interest rate off of that. The interest rate is then absorbed by the bank on their loans that they give to mortgages and other businesses. And then a very small percentage of that is then fed back to you as a depositor. Obviously the spread is there's a big spread because the interest they charge on their loans is a lot higher than the interest they're going to give you back on your savings account. And personally, a savings account isn't enough. When you enter the real world and you start accumulating more assets and liabilities on your end, it is my firm belief that you should also have an investment account to go along with it. So investing money is essentially lending it to an entity with the expectation of getting a big return back from it. So common return, some of the forms in a common return is our capital appreciation, and then dividend income, then coupons from fixed income. So capital appreciation is sort of the first thing you think of when investing. Warren Buffett investing half $500 million in the market several years ago, and now he has turned it to over 6 or 7 billion from then, or even greater than that. So that's capital appreciation, just the raw price difference between your asset that you bought years ago and the asset that you then sold it for today. Then we also have dividend income. So when you buy shares of Apple or Amazon or Microsoft, you are buying into ownership of that company. And all three of those companies pay a dividend. So profits for that quarter are then fed throughout their financial statements, and then what's left over from all of their operating income, all of their external liabilities that they need to pay out, they then take a portion of what's left and they pay it out to their shareholders in the form of a dividend. So that's sort of the relationship between a shareholder and a company. We as shareholders have a portion of that company, and in return, the company gives us a little bit of profit back every quarter or every year, depending on how what their payback schedule is fixated upon. And then we also have coupons from fixed income. I'll dive into fixed income. Fixed income, it's a very popular investment vehicle, but it is a bit complex, and for the sake of this introduction, I'm mainly going to be focusing on stocks. But just know that a lot of investment accounts do focus on both stocks and bonds. The fixed income is just another name for a bond. And then entities in which we can invest in publicly traded companies, and you can also invest in governments, both foreign and domestic. So some of the fundamental terminology that we're going to be starting off with is market. So the market is essentially, it's not imaginary, but it doesn't have a physical space. When we think of a market, we may go to the farmer's market on Saturday morning. That's a physical market where you can buy and sell goods. The market, in terms of securities and public finance, is now it's digital, and we still have exchanges where buyers and sellers and market makers still interact with one another and move a bunch of volumes of different commodities, stocks, bonds, and other financial instruments. So just think of the market as a broad, very broad entity. Securities are essentially investment products. So stocks are securities, bonds are securities. Commodity contracts on corn or cows, those are securities too. So think of security as a way to secure your money, secure the bag, if you will. Stock, essentially it's equity in a company, a portion of ownership. Debt instruments are also called fixed income or bonds. They're essentially debt that a government or a company sells out to investors, and then in exchange they then pay out interest to those investors over time, just for holding the bond. An index is an aggregate of a certain amount or type of security. So the S&P 500 is an index of the 500 largest domestic public companies in the United States. The Dow Jones Industrial Average is an index of 30 companies, but those 30 companies are industrial companies that form sort of the economic foundation of America. And then you have international. You have the DAX, which is a German stock index. You have the Hang Seng, which is the stock index out of Hong Kong. You have the Nokia, which is the stock index of Japan, and so on and so forth. Every company, I believe, has their own stock index if they participate in the financial markets, I believe. And then the last term is a fund. So a fund essentially is a bunch of capital or money. That's what capital is money. And it's allocated to a specific security to serve a specific objective. So a fund could be a certain amount of capital raised by a certain company to track the S&P 500 or a certain portion of the S&P 500 or a certain portion of a stock exchange or stock index out of another country. The list goes on, and there are hundreds, if not thousands, of different funds out there. Funds also can be private. There's such a thing called private equity, which is companies that have the objective of investing and making money off of companies that are not publicly traded. And those are private funds. All right, so we care about what type of investment accounts and what type of investments we can invest in and what we can start out building up right now. So, if you ever seen the financial news or read any Yahoo Finance, they mentioned portfolio a lot. So portfolio essentially is just a combination of securities. That is your. So if you're an artist, you have different paintings and different art projects that form your art portfolio. As an investor, we have different stocks, bonds, commodities, funds that make up our portfolio. And we can essentially have a handful of different investment portfolios, but they mainly break down to two fundamental accounts. So the first one we have is brokerage, and then the other is retirement, and I'll cover that on the next slide. But short and simple version is a brokerage account is something, for you not to play around with, but to build and to test out different strategies, right here, right now. A retirement account is specifically an investment account that you open and fund in order to build it over the entirety of your lifetime in order to build up a certain amount of wealth that you can then withdraw at retirement. So when you retire at 65 or 70, you want to go lay on a beach for like the next 20 years, you have your investments pay for it. That's the type of account you would withdraw from. And portfolios can have different themes if you want a themed portfolio in general, and they can also have different investment strategies. And two broad examples of an investment strategy is passive and active. So putting your money in an index fund, which tracks a certain index, such as the S&P 500, funding it, let's say, putting $100 in it every month, not touching it whatsoever for the next 30 years, that's a passive strategy. Your money is going to grow with the index over time. But if you're actively buying and selling shares of Microsoft or GameStop or cruise lines or certain airline stocks or banking stocks year to year, that's what we call active investing, because you're paying attention to trends, keeping up with their financials, and you have more skin in the game when it comes to each individual company. The risks are also higher with active investing versus passive. And generally speaking, if you're able to perform active passing successfully, your returns are going to be higher, because generally in finance, there is a correlation between higher risk, higher return. All right, so talking a little bit more about the different account types that you can have. So brokerage is our most fundamental account, and it's used for your personal financing. So your goal is to build wealth and generate income out of this. So you can do this through capital appreciation off of the stocks and bonds you hold, or the dividend or the coupon payments off of your bonds that you hold too. So if you invest, if you have $100 million invested in a brokerage account, if you wanted to, you can put all that money into certain companies and just have the dividends essentially pay your salary or pay for your lifestyle for the entirety of your life. But of course, I take it none of us have $100 million in this group. If we did, though, definitely let me invest it for you and charge you a fee for it. And then another account type we have is retirement. So this includes traditional and Roth IRAs as well as 401ks. So a 401k account is an investment account, but that is through your company. And a lot of times your company will match your contributions to a certain percentage every paycheck you put into it. And an IRA is essentially, it's an independent. So it's a 401k essentially, but that's through you and your brokerage account. The company has nothing to do with it if you don't want them to. So the goal of this is to build up wealth via investments for retirement. So there's two ginormous differences, and that has to do with the taxing. So a traditional retirement account has the funding on a pre-tax basis. So when you get paid, the first thing that comes out of your paycheck is tax. That's the difference between your gross pay and your net pay. With a traditional retirement account, your funding to your retirement account that comes out of your paycheck comes out before tax is applied. So that's good, though. Tax doesn't take anything away from your retirement account funding. That's good. But if you think about it over time, the way a traditional retirement account works is that when you are able to start withdrawing at age 59 and a half, when you take out the money, the gains from that account, those gains are then taxed. And that they generally tax at a higher rate than 30, 40, 50 years ago when you started it. So overall, you are going to be end up paying more tax when you retire. And when you retire, you don't want to be paying any tax whatsoever, because you just want to enjoy the income. That's where a Roth comes into play. That's where Roth has its strengths, because a Roth is in a retirement account where the funding is then taken out after tax is already taken out. So the money is already taxed. So the government can't tax your withdrawals when you want to retire. So in a way, that is a good way to save up. And throughout time, the tax rate has increased steadily too, to match the consumer price index, to match the wealth disparity, and the wealth inequality, as well as the income inequality that has been also growing with America as well. So, by the time we're all 65, 70, the tax rate is going to be higher, noticeably higher from it is today. So, not financial advice, but if you did have to make the decision, definitely go with a Roth. And also, Roths are also applicable to 401k plans as well. So, your company can open up a Roth on your behalf if you designate them to, because a lot of times the default is traditional. But definitely make sure to push it upon them when you get a job, when you start getting those nice paychecks, those nice fat paychecks, that you want a Roth 401k, not a traditional. And then our third account is a managed account. So this essentially is where you pay a professional every year to manage your investments for you. So a lot of times these are with core portfolios, blended. You can even meet with a financial advisor and have them tailor make a portfolio to you if they're able to do that at certain firms. So it varies depending on who your broker dealer is, who's your broker. And they usually charge a fee per year to make your investments grow. So, if they charge, 1% every year, and you have $100,000 invested, and they grow it, that's going to be $1,000 a grand out every year. But then again, those are specifically for people who have a lot of wealth or not the time to put any time into research or any asset allocation. An asset allocation, that just means how much money you're going to put into security A versus security B, stocks versus bonds, Microsoft versus Apple, apples and oranges. All right, so this brings us to some common misconceptions I want to bring up. So, a lot of people think, when they start, when they first download Robinhood and they get some funds from their savings account, they think, they can time the market and they can, buy when everybody's selling and sell when everybody's buying. That doesn't happen. A lot of times we might see this Wolf of Wall Street or these ginormous, blockbuster finance movies that, sort of, mislead the viewer and such that, they say, investing is easy. Anybody can do it. Anybody can make, 15 grand a month off investing. That doesn't happen. Because a lot of times people are going to brag to you about how much they make, but they'll never tell you how much they lost in the markets. And people lose a lot more than what they think. So market timing can be accomplished easily and it can be predicted. That rarely happens. Very experienced professionals can do it, but you or I, right off the bat, looking at a graph, can't. However, though, during COVID-19, a lot of people did buy the dip in March. So as the pandemic burst out and as everything was shutting down, a lot of investors were selling their stocks and bonds and moving their investments out to safer storages of wealth, such as savings accounts, checking accounts. A lot of people started putting money into gold and silver. But a lot of people held on. And if you can see, if you held on right at the end of February and didn't sell off at the bottom of March, you would have then had, if not, you would actually had more. This was taking it by the time of November last year, but even so, the S&P 500 is well above $4,000. So it also goes to show you the importance of buying into your investments and also holding them. I think Warren Buffett said, if you get scared and you sell off at the first sign of a sell-off, then you shouldn't be holding your equity in the first place. And that's very true. a goal of investing isn't to make money quick. It's not a get rich quick scheme. It's not like your typical pyramid scheme on Instagram. It's something where you dedicate a little bit of time and research into. You save up, you put some money into it initially, then you keep on putting money into it, and then over time it pays off, because what you're doing is you're betting positively on the economy and you're putting money into the economy. And economies are designed to grow, especially within a capitalist economy such as America and Europe as well, and all across the world. A capitalist economy is designed to grow and expand and benefit not only those who own the companies, but also the shareholders of those companies as well. That's why people invest. Again, an index is just an aggregate composition of various companies. The S&P 500, 500 companies. S&P 400, it would be the top 400 companies, and so on. So another couple of misconceptions is that anything you make off your investments is 100% yours. That's not true. If you put $1,000 into a company and then you sell it for $4,000, that's great. Your capital appreciation has then been $3,000, the difference between $4,000 and $1,000. But the U.S. government, when it comes time for tax season, unfortunately, every year the IRS is going to come a knocking if you don't declare that $3,000, and they are going to tax that $3,000 gain. And then another misconception is that stocks always go up. You could buy into a company and say, "Oh, it's fine. I'll just leave it alone. It'll go up in a year. I'll be rich soon." No, because a lot of times companies can go bankrupt. There was a German company a couple months ago called Wirecard, based out of Berlin. They're a finance company. They lied on their balance sheet and misplaced, air quotes, misplaced about $2 billion on their balance sheet. When the dirt was revealed, their stock price went from over $100 in the matter of like 2 days. It went from $100 to below $2. So that's over a loss of 98%. So basically, if you had money in Wirecard, you lost it all if you didn't sell it then. So it is very important also to keep track of what's happening in the world, and keep track of your investments and what's going on with them. Keeping track of how ethical a company may be, because companies can go bankrupt. A lot of them do. And then a company may or may not recover from an economic crisis. Example, small businesses closing during COVID closures, or if you had money invested in cruise lines or some unfortunate airline stocks and they went down. Some of them haven't recovered yet. It's a month since or not a month. It's been over a year since the pandemic was officially announced, and a lot of companies still haven't reached their pre-COVID levels. If you a couple companies also the name that went bankrupt is Hertz, the car rental company, as well as GMC, the company that sells supplements. It's economic linkages. If gyms close, if people are staying at home, they're not going to be going out and buying supplements or being as active as they were before, or working out. So supplements are going to take a dive in sales. And in terms of GMC, they had a lot of debt and they couldn't repay that debt, so they ended up foreclosing. So I mentioned the word BD and broker dealer. So what exactly is a broker dealer? So you can think of a broker dealer as a company that acts as a middleman between companies and people, and capital markets. So we as people, we're known as retail investors. Companies and pension plans and endowments, such as the endowment we have here at Denison, those are what's known as institutional investors. Those are the ones that are buying and selling, $30 million worth of stock within one trade. Those are Goldman Sachs, Morgan Stanley. Even our endowment makes a considerable amount of trades and size through our limited partners. Those are the ones that are really moving the markets, because how a stock price moves, day to day is amounts of shares of that company that are just bought and sold periodically each hour. And those are those Morgan Stanley's, Goldman Sachs, those giant banks and other institutions, those hedge funds that are selling thousands, if not hundreds of thousands of shares minute after minute. Those are the ones that make markets move. And a broker dealer essentially will take your money when you want to buy something, and it will find a seller on your behalf, and it will enact the trade for you. And sometimes what they'll do is they will take some stocks and bonds and they'll hold it within their own stores. And then when they think the price is right, or when enough people are interested, then that's when they will buy and sell it to you directly. So that's where the dealer portion comes into play. The broker is the middleman portion. So short, broker dealer, BD. So some of the most commonly known broker dealers are Robinhood, Charles Schwab, and E-Trade. I'd be surprised if nobody here knew what Robinhood was, but Robinhood is the famous mobile app, and they also have a website app too. BD, where you can easily buy and sell within minutes after funding. So again, a BD pairs up buyers and sellers. And some other broker dealers and also helpful investor resources I've had throughout my investing experience are on the right, but other BDs are going to be Vanguard, Fidelity, TD Ameritrade, and then your bank also should have a broker dealer subsidiary within it. So I know Chase, right on their app, if you have Chase, they'll one of their main tabs are investments by JP Morgan. Huntington has Huntington Financial Advisors. Wells Fargo has Wells Fargo Financial Advisors. PNC has financial advisors. Bank of America, Merrill Lynch has financial advisors. I believe Merrill Lynch also has a pretty interesting mobile app too, that's centered around investing too. Then honestly, I'd be surprised if any bank that exists today doesn't have some sort of investment company or financial advisor branch within them. So, if all else fails, you can just go to your bank and just ask for a financial advisor or information on investments from the bank itself. Some of the resources I've used are Yahoo Finance. Yahoo Finance is completely free, which is really nice. Motley Fool. Motley Fool's more of an article, sort of a newsletter of what's happening on, and they also release those clickbait articles that read, if you have $10,000, here are the top 3 industrial stocks to invest in, or if you have $1,000, here's what to do with it, and so on and so forth. Microsoft News also has some pretty interesting articles on investing, money management, what's going on in the markets. I can't imagine anybody uses Microsoft Edge, but if you use Microsoft Edge, Microsoft News gets pulled up automatically on the homepage. You can also use the stock apps on your iPhone or on your iPad. I found it pretty helpful too, because you can have it form a widget, and you don't even have to go into the app. You can just scroll through and see what are the markets looking like today. What's up, what's not, what's hot, what's not. And you can also, if you sign up for and put money in with a broker dealers also offer in-house research with you. So articles, blogs, even helpful videos, even chat rooms with professionals on the other end, which is really helpful. Disclosure: I do use E-Trade, and I have used a bunch of their research resources before, and they are very helpful too. And if anybody's interested too, you can always feel free to reach out to me via email, and I can send you some other resources as well. All right, so just going briefly into it, stocks and bonds. So stocks are shares in a company, a very small portion of a company. They are seen as riskier than bonds. Some pay dividends based on the stage and the financial health of the firm. Some offer greater capital appreciation, depreciation based on how much of a growth stock it is versus value. And value just means that a company is very well established and it's not going anywhere, if you will. So, Microsoft, unless some ginormous scandal happens, the stock price isn't going to like plummet half in one day. Bonds are essentially debt that a company issues that we as investors buy, and then at the end of the lifespan of the debt, we get our principal back, but then we also get interest paid out every single year to us from the company or the government, depending on if you buy a corporate bond versus a treasury bond. A corporate bond is when you buy debt from a company. Treasury bond is when you buy debt from the US government. So, and they also provide income over time. So if you have, $250,000 and you put them on bonds, then those will steadily generate income for you over time. All right, so here is a snippet I took from Yahoo Finance. And this is over Microsoft. So as I mentioned, Yahoo Finance is free. It shows greatly how the secondary market works. The secondary market is essentially what we trade and invest in. So the primary market is when a company directly lists their stock and sells it to investors. The secondary market is when we buy and sell to each other and broker dealers. So just going to walk you all through on how to read this page, and it might look a little bit confusing at first, but I'll try and help that. So the 259.5, that's the price for one share of Microsoft. And then the numbers next to it shows you the gain it had during that day. And then the number after it, or to the right of it, shows you after hours. So markets open at about 9:30 every morning and close at 4 every day. That's on Eastern Standard Time because everything is based out of the New York Stock Exchange here in America. After hours is just what people peg the stock going at after the markets close. So the market cap of Microsoft is on the right-hand column. It's at $1.95 trillion. All that means is that the market cap is, well, aside from the general size of a company, it's the amount of shares outstanding it has, how many shares it's willing to shell out to investors, and that's just multiplied by the share price. And below that, you have your forward dividend yield at $2.24 per year. That's less than 1%, but it is a dividend. So every year you are getting 0.88% on your Microsoft investment. So if you bought 100 shares of Microsoft, you would be getting about $224 every year just by holding and not selling Microsoft, which is pretty nice. And then to the right of that is a price chart. So during the day, it shows you where the price fluctuated and where it moved. And you can, on Yahoo Finance, go as far back as 5 years, all the way back to its initial public offering or IPO, or the date when the company first began to trade publicly in the stock market. Yeah, and then also volume. So volume is also another important factor. It's also pretty cool too, because if you look at volume over to the bottom left, you can see that during the day, over 23 million shares of Microsoft were bought and sold throughout that day, just that day. And the average volume is the volume over the past 10 days divided by 10. And that has been about a little over 30.4 million. So every day it's averaged out to over 30 million shares of Microsoft bought and sold. So, and if you go into trading in the financial services sector, you're going to be on the phones, you're going to be up and at it, every minute of every hour of every trading day during that 9:30 to 4 o'clock time span. All right, and then here is a snippet I took from E-Trade. So E-Trade also has quotes, and this is what's called a quote here, or a snapshot. And every BD that you have, they also list quotes that give you base fundamentals as well as other information you can look up on the company before you invest in it, which is nice. So here, if we go back, 5 years, Microsoft was trading at underneath $100. Now it's trading at near 260. So if you held Microsoft for 5 years, you would have doubled your investment, which isn't bad. You would also had your dividends. You can also have those reinvested. So really, that just maximizes your gains. And then E-Trade has it quoted in quarterly dividend. Yahoo Finance has them quoted in yearly dividends, but they're the same. And every BD is going to have a quote or a snapshot that looks a little bit different. All right. So how a bond works. So fundamentally, let's say that Microsoft issues a 5-year bond to raise money. So I'm Microsoft, you're an investor, I sell you a bond. So I sell you a bond, and in return, I get money for that bond. I can use that money to expand operations. I can use that money to help sell more product. Whatever I want to do with it, I can do with it. So the par value on a bond is the principal, or the money I get immediately, the money that you give me by buying the bond. Usually they're quoted in groupings of $1,000. Every bond has a coupon rate on with it, if it has a coupon rate. So let's say I'm paying out a coupon rate of 10%, which by the way is unheard of, because right now it's like, I can't see any corporate bonds that release more than like a 3% coupon rate. So that means every year that you hold the bond, I'm going to pay you 10% of $1,000 or $100. So that means in 5 years, you would have received an additional $500 just from holding a bond. And then at the last payment that I issue you your coupon, I also give you that $1,000 back, because that's the principal, which is pretty nice. And then a frequency is how often I'm going to pay you your coupon. So generally speaking, they are either in an annual payment or a semi-annual. Most are in semi-annual. So every 6 months, I'm going to give you $50, which is half of that 10% annual coupon rate on $1,000. And then also, if you also wanted to, you can also look up bonds on Yahoo Finance or your broker dealer's website, or even if you want to go to a bank and see, what type of bonds your bank is issuing to investors, you can do that. So, when the bond matures in 5 years, the bond closes out. Microsoft, I give you back $1,000 along with interest or the coupon. So at the end, you put $1,000 in, you waited 5 years, you got $1,500 out. Not bad. But of course, bonds don't return as much, historically speaking, as stocks. But bonds are also seen as a more safe investment. All right. So some of the risks associated with investing. The first one is that every dollar you put into the market, it benefits the economy in some way, yes, but you also open that dollar up to more risk. So, if I, put $10 into an investment and it returns 100%, doubles my money, and I say, oh man, I should have put $10,000 into that investment. I would have had an additional $10,000. My total capital would have been $20,000. Why did I make that mistake? Well, it could go one way, but it also could go the other way. You could lose half of it. So if I put $10,000 in, I could have lost $5,000. If I put $10 into an investment, I could lose $5. You can't predict the market. So any dollar you invest in the market, you have to be willing to lose it or lose a portion of it. That's just something you have to keep in the back of your head as an investor. Volatility is what we call large fluctuations in prices. It refers to risk, really, or you can also associate it with the term variance if you have taken a stats course. And that also plays in with standard deviation as well. So the more volatile a security is or an investment is, the more risky it's going to be, because you could be up 1,000% one day, then you could be down 50% another day, or vice versa. So a great example would be COVID. COVID caused everybody to start running around with their heads cut off. People were frantically selling, panic selling. People didn't know what was happening. People were, terrified of investing. People weren't confident investing anymore. Now we're entering a market where people are starting to regain confidence in the markets. They're starting to put money back into the economy, putting money back into their favorite companies that are emerging out, companies that really benefit from reopening, companies that benefit from curing COVID, so on and so forth. So just being able to keep it in mind that when you invest, you are going to be putting that at more of a risk than you are just by keeping your money in the bank. And some additional disclosures with investing. So at the beginning of the year in February, we had the GameStop fiasco where Robinhood decided to limit, the amount of GameStop, AMC, Nokia that people could buy, as well as other extremely risky stocks. And while a lot of people do count that as market manipulation, that is a risk with investing physically in a broker dealer. Your broker dealer could stop you from buying additional. What they can't do though is they can't prohibit you from selling, because that is 100% illegal, and that is actually an actual claim. Buying though, on the other hand, is where it gets a bit hazy, but broker dealer does allow you to sell your securities if you want to sell them at the current time. So wealth can be built with any broker dealer. I'm not bashing Robinhood in any regards. I'm just saying that it always is a good idea to read the disclosure statements when you open up your brokerage account or a retirement account, and reading about some of the risks that they perceive with investing, because everybody has different risks that they associate with different investments. So just making sure you take the time to read, because I know, for all of us that have iPhones or phones, when we have like a software update, a lot of times we just scroll to the bottom where it says I accept the terms and conditions. You check that box. You don't read anything. Here though, I do encourage everybody when you start off investing to actually read, because yes, it might be long, but it is very useful, and it is very important to understand what you're going to be doing with your money, especially if you're going to be putting part of your livelihood and a part of your income down the road into investing, because this is going to be what finances your future and what helps make life a little bit easier down the road. All right. So last slide before questions and answers is tax implications. So unfortunately, taxes are associated with investments. Various tax rates depend on investment accounts. Like I said, with IRAs and 401ks, you have traditional and Roth, where traditional has tax taken out with withdrawing, but IRAs have, or Roths, I misspoke there. Roths have tax taken out when the funding occurs. A brokerage account has taxes too, associated on your tax returns every year, but those come in the form of capital gains tax and also income tax through dividends. So I know off the top of my head, there are two main capital gains tax. There is long-term capital gains tax, and there is also what's known as a short-term capital gains tax. So currently, long-term capital gains tax is where they can't tax you on more than 20% of the profit you made on an investment. And that is high. So, if you make $1,000 off profit on one of your investments, the most they can take away from that on tax is $200. They don't always charge a tax rate of $200. Generally speaking, the longer you hold something, the more likely it is to be a decreased long-term capital gains tax. Short-term capital gains tax is where they can really get you, because for certain brackets of profit, there are certain marginal tax rates that are associated. I don't know them off the top of my head, but you can just Google them. But just knowing a short-term capital gains tax is associated with when you buy or sell an investment within 1 year. If you buy something and then sell it like a year and a half later, 2 years later, that's a long term. So short term is anything under a year. Long term is anything greater than 1 year. And that's where trading versus investing also takes place, because trading is buying and selling within a year, but investing is generally seen as long-term, holding something for greater than 1 year. All right, so that opens it up to Q&A. If anybody has any questions or anything they want to bring up, I'll be more than happy to elaborate. Or if you need me to go over something, I'll definitely do that as well.
I have a question.
Yeah, absolutely.
Sure. So was the traditional, I guess you mentioned like traditional versus like Roth IRA. Is the traditional the same thing as the pension, or is that a different thing?
Good question, Anna. Thank you. A pension plan is a retirement. It is a retirement account that your company or a certain organization. It's usually a municipal organization. They set up a pension plan where you buy in, or your plan is in with that. So it's a pot, and then that pension is then managed by a third-party asset manager or another firm. So pensions are small in comparison to other retirement accounts because not every job has a pension, because they are generally associated with public municipal jobs. So teachers have pension plans, firefighters have pension plans, police officers. If you work for the state, you are also given a pension, and that's you own a small portion of a pot of allocation capital that is managed by another company. So that's where it differs. So retirement account is something that's directly linked to you. A pension plan is directly linked to you, but it's managed by another party or another firm, and you don't directly pay any fees for that. They essentially take care of everything for you, but also you don't have control of the investments. That is left up to the board of that municipal organization and also the third-party asset manager.
Thank you.
You're welcome. All right, I'm feeling some energy to answer one more question, so I'm gonna call on a volunteer. Stephen, I know you're there. Do you have a question for me?
Yeah, sure. So one thing you mentioned was the investment in like gold and silver, commodities like that. So like, can you like go into detail like what that actually sort of like looks like? Like is it more of like a certificate thing, or like can you like literally just like have the gold if you like want to?
Yeah, great question. So there are different ways to invest in a commodity, and a commodity is just a physical object. So gold, silver, corn, wheat, lumber, coal, oil, um, livestock. Even people started trading water as a commodity, which is crazy to think about. Um, so usually with precious metals, when you buy them, you usually have to pay to have them stored in a vault somewhere. So a lot of people have like a firm. They often the Cayman Islands. In the Caymans and also in the Caribbean, they have well, they keep their gold and other precious metals there because of tax implications, and they get a lot of tax breaks by keeping it there, just because it's off of U.S. soil physically. So the U.S. can't charge their marginal tax rates on any buying and selling of those precious metals that people keep in store on the sort of the warmer climate islands down south. Yeah, so that one way would be to buy directly from one of those precious metal firms and pay an annual fee to have them store it within their vaults. And over time, then you would sell it and collect the profits. Another way is to buying into a certain fund that invests in those commodity contracts for you. So that's a more indirect way of investing in commodities. And then you can also, it's crazy to think about, but you can also invest in mining operations and the processing of precious metals too. So if you really wanted to, you can invest in a gold smelter and like have like a steady source of revenue off of a small portion of gold that smelter produces. But the most popular way is to buy it directly and have it stored. Of course, we're talking about people who have a lot of wealth and people who have a lot of confidence in the store value that precious metals exert. But of course, now there is also, I know everybody has heard of Bitcoin and various cryptocurrencies. Bitcoin I think today has hit 63,300. And so, it's blown gold out of the water in terms of returns. Everybody's saying, gold, Bitcoin's the new gold, Bitcoin's the new source of value. Bitcoin's going to replace the dollar. Cryptocurrencies also may be a valid source of a valid storage of value over time. This isn't financial advice. I'm just saying, it's something you might want to look into because it is an emerging asset class. And asset class is just a select type of security. So U.S. stocks is an asset class. U.S. bonds is an asset class. Your European stocks, that's another asset class. Commodities is an asset class. It's more known as natural resources and cryptocurrency, and that's going to be the emerging asset class of our generation. So it is going to be interesting to see what happens over the next couple of years. But that to answer your question in a more shortened statement, Stephen, yes, that is generally how people buying it outright and paying a separate party to hold it for them.
Awesome. Thank you.
Yeah, anytime.
Seems like that's it, but I'm going to stop recording, and thank you so much for presenting today. I know I definitely learned a lot.
Yeah. I'm always open, and if anybody has